Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. Welcome, everyone, to the Market Radar podcast. It's April 16th, 2022. My name is Artie. I'm here with Gamma. Let's get started with the year-to-date performances. S&P down 7.83, NASDAQ down 14.94, Russell down 10.56, Dow Jones down 5.24%. We are still in a stagflationary regime. System strength has been slowly teetering downwards. That's due to certain assets, including the S&P going neutral. So that affects the system strength. The S&P does look like it's going to be going bearish again, which would strengthen the stagflationary strength and also the deflationary strength. So we'll see where that gets us. We might be slowly transitioning to a deflationary phase, but not yet. So let's get on to the calendar. On Monday, we've got Housing Market Index. That's all we got for Monday. Tuesday, we've got housing starts and permits. Wednesday, we've got existing home sales, EIA petroleum status report, and the beige book at 2 o'clock. Thursday, we've got jobless claims, Philadelphia Fed manufacturing index, and EIA natural gas report. And then we've also got the Fed balance sheet at 4:30. And then Friday, we've got PMI composite flash. Let's take a look at ES for the week. Pretty big gonging for the week. We broke through the base that we were talking about yesterday, the double bottom that the market made. Broke through that and saw lower lows from there. As of now, keeping it simple, we've got the Momo. S&P staying under Momo, it's likely to go lower. S&P above Momo, break above, it will go higher. But as of now, looks like we're headed towards the lower vamp. But, we're not genies. We can't predict day-to-day movements. We're not going to pretend like we can. We just know it's stagflation and you're going to get chop. We're not going to get big runs in either direction until we get a flip to deflation or one of the risk-on regimes. And let's take a look at 10-year yields. So we drew this trend line here. This is a trend line that was a raving topic on FinTwit, that the rates are going to reverse because of this trend line. We just broke past it, just barely. We'll see what happens if it really does reverse. But at the end of the day, a line is not going to predict bonds. Like, that's just not how economics work. You gotta, technicals can work, but you have to use it in line with other things like macroeconomics and other tangible reasons to go along with the technicals. So here, an arbitrary line just isn't going to work. We know rates are going to be going up. They need to go up, and we've talked about many reasons why with real yields and everything. This thing is not stopping at this line. So we'll see how that plays out, though. We'll see. Maybe the line wins. I don't know, but I doubt it. So today's topic, we want to talk about HYG and its importance in the market. And it is somewhat of a leading indicator as well. So let's hear it. Let's hear what you have to say, Gamma.
Okay, so let's start with, defining what high yield is, right? What are high yield bonds? So, they're a bond category with a rating of BB or lower, and that's considered junk on the S&P rating chart. So if you're at or under BB, you're in junk territory. So high yield bonds they're basically junk bonds. Now, You may ask, why is this something that's important, right? Like, what does junk bonds have to say that SPY or NASDAQ doesn't say? And it's the fact that they are the bond market in general is the biggest market. It trumps the equity market by roughly like 30% or somewhere around that number. You know, we got 70 trillion roughly in equities and over 100 trillion in bonds. So if the bonds are moving a certain way, it's very important to watch because bonds are usually right, right? That's how it is. Bonds and credit usually call the move first, or they're the early ones, and they usually get it right. Oh, you know, rightfully so. It's the biggest market. It's where the big institutions and big whale money moves is in fixed income.
Yeah, and they're the
So
ones that know what's going
right,
on,
right,
essentially.
of course,
There
and
are,
they're
you
gonna
don't
get it.
really see retail bond traders.
Yeah, of course
Don't
not,
really hear
because it's
about that.
because let's put it to you this way: you got $100 million, right? You're not trying to make 10% a day on it.
Yeah, that's just
Yeah,
you're not going to
that's
risk that much with that much
right,
money, right?
right. That's the point. So um, let's look at HYG here on the left. We have the normal chart. If you were to type this in, and we'll even disable DDAP for easy viewing. If you were to type this into your quote system, your trading platform, this is what you'll see. The problem with the way the chart looks is many people will put this chart into their trading system or the quote system and say, "Oh, it does nothing, useless." You know what I mean? It goes sideways and down. Like, what is this? This is how could you use this? Well, when you look at bond ETFs, specifically junk bonds, you have to pay close attention to what you're really looking at. You're looking at a chart with the dividends constantly being removed. Remember, because when it goes ex dividend, the underlying will lose the amount that is being paid in dividends. So if you're at $10 and the dividend's 1, ex dividend it's going to be at 9. So this high yield chart HYG or JNK, it's another junk bond ETF. They're always going to be looking or seeming as if they're going lower. But in reality, HYG at the current prices is yielding 4.39% a year. By looking at the chart at face value, you are not seeing that 4.39% a year as a gain. You're seeing it as a loss.
Well, so essentially, you're not getting equity gain, but you are getting
That's the point.
consistent dividend income.
You're losing 4.39% face value, but this is not accounting for the 4.39% in dividends being pushed into the account that owns this underlying, right? So you're really just seeing it lose value, but that value is not really lost. It's being reciprocated in a dividend, which, if you reinvest dividends, is compounded further. So what we have to focus on when we look at high yield, because a person that owns the underlying basket of high yield bonds or just HYG doesn't experience this chart directly in their account. You understand? Like, if I owned HYG from here on December 2018 and haven't sold it, I wouldn't be at $80, right? I wouldn't be flat.
Yeah, you'd
You know what
have
I mean?
a bunch of dividends since then.
I'd have a
Like,
bunch
what
of
is this
dividends
paid?
appreciate.
Does this pay monthly?
I'd have to look. I think it plays. Yes, I think it pays monthly. If we zoom in, we can tell. Yeah, it's monthly.
Yeah.
Pretty much monthly. So you have to understand what you're looking at, and I mean, you could do this with any underlying, but specifically with high yielding assets, this needs to be accompanied for because it's a very big factor. You know, something that pays 1% a year, you can adjust for dividends. We normally don't look at a dividend adjusted charts, but this is what we're talking about today. Is on the left we have HYG, and on the right we have HYG. Both current. These are both that would take DDAP off. These are both the same chart, but one is adjusting for the dividends while the other isn't.
Okay.
So
So
you're seeing.
what's the significance? Let's get into that.
Okay, so let's go into the significance. When you look at bonds, like I said earlier, they're the biggest by market size. So let's take the biggest. Let's look at when we're looking from a risk standpoint. Let's take a step back and let's look at the bird's eye view. Where does risk start? If you know anything about risk, it starts with the most risky. When it's time to trim risk, it starts with the riskiest items going out first. Micro caps, small caps, so on and so forth are being the first ones that see the pain, but they're also the first ones that see the upside as well. They're the most sensitive to changes in risk. When you look at it from a bigger perspective, in the bond market specifically, there is no micro caps or small caps. So where does risk start in the bond market? At treasuries or at junk? It's going to start at junk and work its way up to treasuries, right?
Okay.
People are going to sell a junk bond before they're going to sell a treasury bond.
Yeah.
So that's the aspect. When we're focusing on the biggest market by size and the risk of that market. So we're disregarding equities in this analysis right now. And we're saying, okay, let's look at a risk parameter of credit, which trumps equities. Where does risk start when risk starts to unwind? It's going to start in high yield. And it's going to work its way all the way up from high yield to corporates, municipals, and then eventually treasuries,
Yeah, it kind
which
of
is
works. Comparing it to real estate, it kind of works the same way.
right.
With real estate, you see the more expensive luxury listings, like 2 million, 5 million, $10 million homes. Those are the ones that get hit first because those prices are the ones that are like the riskiest and most up to fluctuations. Like
Right.
they
And you know what?
fluctuate the most, right?
There's another comparison. You go to the watch market, right? If you look at the watch market, um, for those listeners out there that know watches, you look at it at a stainless steel model or Rolex model, right? And then you go to a Richard Mill. The Richard Millie is going to deviate up and down faster than a typical stainless steel model will ever move. That's because it's more hype, there's less, it's more expensive, right? So let's look at 10%, right? On 15,000 or 400,000.
Yeah. So
10% on 400,000 is 40 grand, 10% on 15,000 is 1,500 bucks.
essentially,
So
like those are higher risk to reward ratios.
there you
And
go.
essentially,
Perfect
the
way to put it.
higher the risk to reward ratio you have, those get trimmed off first when it's high risk situations.
Right. Now the example I made, there's obviously a rarity case, one of one in the world. Not There's no market for it, right? But you get my point in general. What we're trying to make is the more you go in risk, or the more you increase the underlying risk, the faster it's going to change.
Yeah.
That's really what this is summed up to. So if you look at high yield, it's the highest, or I should say, the lowest rating on the bond totem pole, which is the highest risk. So it's going to shift significantly a lot faster than um, other types of, or I should say, other classifications of risk in the credit market. So let's focus on the dividend adjusted, and that's what we're going to talk about today. Is if you adjust for dividends, basically you include dividends in the price performance of the chart, you'll see that we're going to maximize this, and we're going to look at HYG on a dividend adjusted basis. You'll see it doesn't look anywhere near as bad as what you thought it did. So those that are viewing, this is HYG dividend adjusted. Let's turn dividend adjusted off, and you'll see the complete difference. Look, it looks horrible. But if you adjust for dividends, it's the complete opposite. Now, what this is showing you is demand for junk. And you notice these big sell-offs, they all usually happen in what we classify in our regime matrix picks up in the system as risk off regimes. So, as we have risk off regimes, the first thing to go in the credit market is going to be high yield. Along with high yield, usually small caps, micro caps, the whole nine gets sold. That's what ends up, this is what we're looking at. Now, we can put DDAP over it and we can see the trends, but that's not really important for today's discussion. We are going to talk about the correlations between high yield, dividend adjusted, and other assets. So, the first thing we're going to look at is HYG and SPY. Now, what are we looking at? We're looking at the blue line here is HYG, and the orange line is SPY. And as we go out throughout the podcast here in the video, we're going to be comparing different underlyings, and they're going to be indicated in orange. So the blue is always going to be HYG. The orange is going to be the revolving indicators that we're looking at. So let's take a look at HYG and SPY. What you want to pay attention to is, what is the market doing? Well, we see HYG bottoming around the times that SPY is bottoming. Basically, they're bottoming at the same time. What and why is that? Well, like we said earlier, when the demand for high yield evaporates and it gets sold off, if high yield bonds are getting sold off, outside of the view of regimes and regime back tests and whatnot, if high yield is being sold off in credit, odds are equities are being sold off too, because equities are under bonds. Bonds are always above equities in size. So if bonds are being sold off, the high risk bonds are being sold off, equities are going to be are going to get sold off as well. And that's what we see here when high yield or HYG takes a shit, right? SPY is usually following in suit. And when HYG is making new highs on a dividend adjusted basis, so is SPY. Notice here in 2018, HYG made a new all-time high before SPY did on a dividend adjusted basis. Same thing back here in 2018, early 2018, mid to early 2018, end of 2018.
So it seems to be like a first mover.
Right. Now, the one time it did lag behind was COVID. It took a little bit longer to get through, but nonetheless, it broke out with SPY. SPY, I mean, within a few months of range, they both blew through their highs. But I guess a way to look at it would say SPY took out its all-time high in August of 2020. Okay. Right after, August of 2020 after the COVID drop. But it did nothing for months. It only started going and accelerating after November when HYG took out its prior high, all-time high. Do you see that?
Yeah,
Like
that's
the
wild.
market couldn't really get anywhere until high yield caught up. And if we go into the shorter time frame, notice HYG made an all-time high into the end of the year on a dividend adjusted basis, and so did SPY. SPY wasn't able to break out until HYG came up from the lows. Originally, HYG's prior all-time high to that was in September. Then we had the market dip a little bit, and then we had a lower high in HYG, and SPY did nothing. HYG finally took out its all-time high, and SPY followed in suit very rapidly. If you remember, to the end of the year, there was those big whipsaw rallies. Well, HYG was able to take out its prior all-time high, and SPY followed. Then HYG fell apart.
Yeah. Well,
So
it seems like it's not always really a leading indicator, but
not so much.
whenever
No,
there's
you're right.
divergence between the two,
Yes,
there's an opportunity.
I think that's the best way to put it. So let's look at the chart right now on HYG and SPY. HYG is on a dividend adjusted basis has put in roughly a double bottom. I mean, down to the penny. I could tell you if we go into a candlestick, actually, yes, we did. We have a double bottom going on here. So what does that mean? Well, if we take out this low and go lower, it's pretty much the reverse of what we said earlier. So remember how we said HYG continually trailing all-time highs? I don't think I did say this. So let's say this right now. If HYG is consecutively making new all-time highs, SPY is likely to follow. If HYG is consecutively breaking down and making more and more lows, SPY is likely to follow. It's just the inverse. Breaking out and going higher, SPY follows. Breaking out and going lower, SPY follows. We can go back in all these times and basically, here's a great example. This is actually going into the flash crash. HYG barely breaks out here. I think it does make an all-time high once or twice here, April, May of 2015. And you have this SPY consolidation, this chop range, right?
Yeah, I
Then you
remember that when the SPY literally went sideways for a year.
right, and now you have HYG breaking down, right? And here is SPY doing absolutely nothing. HYG is collapsing. The flash crash was here in August. Up until the flash crash, HYG fell apart decently. And then the flash crash started. HYG continued to grind lower. We had this big divergence here. HYG goes lower, 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 lower. SPY comes crashing down, makes a new low. But SPY's carnage doesn't really stop until HYG's bottoming. Now, does it mean that what we said earlier, new lows mean lower lows? SPY did make a new low with HYG going lower. Did SPY completely follow HYG all the way down? No, but that's not the point. We're not looking for a one-to-one tracking ratio here. This is not like supposed to be 100% correlated. This is literally showing you that a sell-off in high yield means equity sell isn't, or the equity puke isn't over yet. The bid for equities won't come in until there's a bid for high yield.
Yeah. So
And
how does that relate to now? Now there's a pretty
okay,
big divergence, right?
yeah, now we got a pretty big divergence here. So what you noticed, we had this huge rally here in in um in equities, and high yield didn't really rally. Oh, high yield did, but not as much as, I mean, we could take out a measuring tool here and let's go. Let's see. High yield rallied 3.7%, right? And you might be, you might say, oh, well, equities rallied five. Oh, we're on this chart, so I can't show you. But I mean, we rallied over like 12 or 13% off the lows, right? I know within 9 days or something we were up 11%.
Yeah.
We were up a lot, right? Unfortunately, because of the way the chart is set up, I can't measure it. But regardless, if we go back to another time where this happened, um, where is that here? Let's go to 2018, right? Here, this is 2018. This is the end of 2018 where we had this whole market sell-off. And the market never really broke out. Like it made these like triple peak, these mountain peaks, a little basically um lower lows with one higher high in between. And it fell apart and it crashed. Now, I think we're setting up for something like this. I don't know how realistic it's gonna play out because we did get a deflation pivot here into the end for this flush. This flush actually we needed a deflation pivot to get the entire flush. It was stagflation all the way until then.
Oh, that sounds very similar to what we're getting
Right,
now. And we're
right,
expecting a deflation pivot before the
right,
market really shits the bed.
right. So for those listening that don't see the chart, we are in this chop range. And if you were to go on your free time and look at the SPY in the end of 2018, you'll see exactly what I'm talking about, where it's like whipsawing, but we're not really breaking the lows. The reason being is, again, stagflation is going to burn bulls and bears, but it doesn't mean that the market can't go lower. It means that it's going to be a very rough. It's not going to be a very hard sell. It's going to be like a bait and switch where it goes down, yanks up, goes. I should just say it's going to puke and then aggressively bid and then puke and aggressively bid. And it's going to get you confused throughout the process of where the bottom actually is. So let's go back to what's going on right now, and compare to what happened in 2018. So high yield never really had a big rally. We'll go on a measuring stick here. High yield was rallying 1.8% on these bids. It was only going up 1.6%. We just got in the last month and a half, we got a 3.69% or 3.6, pretty much a 3.7% rally in high yield off the lows, which explains the obscene rally you saw in equities in the last month and a half. Because high yield rallied so aggressively, of course, equity is going to rally too. Remember, high yield gets the bid, equities get the bid.
Yeah. But
Problem
then
is high yields are back are close to their
it
lows again.
literally came right back down.
Right, right.
But the
And
the S&P didn't.
the
So
S&P
there's
didn't
an
yet.
opportunity.
Right. So the big question is, do we hold the lows? And does high yield chop around and put in like a multi bottom? while SPY basically burns, in between 460 and 4 like 20, like chop in that range. And while we put a low and high yield and revert, market turns around. Or does high yield basically crack the lows here at 79.56 area? It's the lows on the candlesticks, if you're wondering. Do we crack the 79.56 and break down and SPY completely shits the bed? That's to be seen. But the way high yield is looking right now, not good for equities, or I should say, risk assets in general.
Yeah.
We're gonna flip now to Nasdaq, and these are going to be more brief overviews because we went over the basics. So if you are watching and paying attention, you understand what we're talking about with high yield and this risk correlation. So even here with Nasdaq, we have Nasdaq is actually more correlated than S&P to high yield. Like we can see that the Nasdaq is much lower than the S&P. It's down almost double what the S&P is year to date, right? It and it almost seems like it's mimicking high yield very closely. Like if we look at we got dips here. There was a higher high.
So
No,
could that be related because the risk reward levels are closer between Nasdaq and the junk bonds versus junk bonds and the SPY?
could be, but like what we could do quickly is we could pull up IWM and take a real peek and see what's going on. I mean, this pretty much, yeah. I mean, IWM is a story in itself. IWM actually shit the bed before high yield did, which I don't think that's. Yeah, actually, it tends to happen in synchronous, but yeah. I mean, high yield hasn't. Excuse me. The Russell hasn't gone anywhere since January 20th. We've been trading, between 190 and 210. So pretty much a 20-point range on the Russell we're going on almost 5 months now. Oh, 4 months, sorry. Almost 4 months now.
Yeah,
You
which
know?
is way more correlated with
Right.
junk bonds
And
than the SPY
I
is.
mean, off the lows, we're trading in a 10% range in 4 months. Remember, in like 9 trading days, the S&P rallied like 11% or something wild like that. So this is obviously much more correlated to the suppression of the Russell 2000 is correlated to the suppression of high yields or junk bonds.
Yep. Okay.
But we're going to take another step further and we're going to dive into some crypto because we had some people ask some questions on the correlation to crypto and what this means, or I should say, how to decipher high yields in crypto. So off the bat, we're going to have two parties here. We're going to have the crypto people, the maxis, as I call them, right? The maxis, they want to sell your house, live in an apartment, put it all in Bitcoin. Those people exist. They're all over Twitter.
Yeah.
They will tell you, yeah, I know.
Not the best portfolio
Yeah,
allocation.
not the best,
100% into one asset.
but it depends on your viewership of that, right? Like, when did you sell your house and put it all in crypto? Was it in 2020? Was it in 2019? Or was it 3 months ago? 4 months ago? Was it at Bitcoin 60,000 or is it at Bitcoin 10,000? Because if you did it at Bitcoin 10,000, you look like a genius. But there's a lot of people that obviously the higher the price of crypto moves, or I should say, the more volatile, and because what ends up happening with crypto is you notice is the higher it goes, the more volatile it gets because more eyes are on it. And there's only 21. So remember, there's only 21 million Bitcoins out there. So the higher it goes, the more eyes are on it, the more demand there is, and there's only a finite supply. There's no issuances, there's no splits, there's nothing. Now, how that plays out long term depends on who comes in and makes a market for it. If institutions and even countries come in and make a market for it, they'll decrease volatility over time. But that's a different conversation. What we need to focus on right here is Bitcoin is a high risk asset. There is no other way to put it. This is not a safe haven. Okay. This is a high risk asset, meaning for Bitcoin to do well, you need high yield bonds to do well. If high yield bonds are doing horrible or they're shitting the bed, odds are crypto will too. And let's go into some examples. So let's go back to early 2016, 2017. Let's look at here. So high yield took out its all-time high in July of 2016, consecutively making newer all-time highs. Bitcoin was ramping, and this was when Bitcoin first started presenting itself in the public. Everyone was talking about it. It went from like $1,000 or whatever, 900, $700 to 19K, right? You remember that, right, Artie? Like that was crazy.
Oh, yeah.
We
Yeah,
literally went
literally
vertical.
everyone and their mom was talking
Yeah,
about it.
right, right. So what ended up happening now is we had this huge pump in Bitcoin and high yield bonds are trading higher. Now high yield bonds start stalling out as Bitcoin is peaking, ironically. And Bitcoin falls down. I mean, this was more of a hype play than correlated to risk assets. This was that remember the markets weren't as deep as they were as they are today,
Yeah, it's
and
a
they're
little
not.
hard to
Yeah,
gauge. There was way less
yeah,
liquidity back
right,
then.
right. But long story short, just the whole point is high yield bonds were making new highs on a dividend. Remember, this is all dividend adjusted. Everything we're talking about today is dividend adjusted. So high yield bonds are making new all-time highs. Bitcoin soon follows. That's what you need to remember. High yield bonds making all-time highs. Bitcoin soon follows, right? So we have this whole exodus here of Bitcoin, and this whole pump you have to take with a grain of salt because you're talking about going from one basically a 19xer in a matter in under a year. There's going to be chop liquidity breaking and all types of nonsense. But long story short, we have this 2018 end of the year high yield starts breaking apart, it falling apart, right? It starts putting it going into a downtrend. And once you really get a downtrend going on high yield, Bitcoin basically shits the bed. And notice Bitcoin and high yields and Bitcoin bottom around the same time here. I should
Oh,
say jump
no
bonds.
way. Is
Yeah.
that a coincidence? Or
I
I
don't
don't
think
know.
so.
It
I
might
don't
not
think so.
be.
So what ends up happening is high yields make a new high here in February of 19. You want to talk about a leading indicator? You know that if high yields break out, Bitcoin's going to be in favor. And sure enough, Bitcoin does a ramp. Now, obviously, we have to take perspective here, right? This is not going to be a tick for tat, boom, this is going to happen. Remember, Bitcoin just 19x from the bottom, so it basically sold off. I mean, we're talking, I think, over 70%, right?
Yeah.
And now it's going to pump again. I mean, we were talking about going from 3,500 to 12,000. I know it's not the all-time highs, but long story short, you get my point. Bitcoin starts falling apart again, right? We get this down move, but we're still well off the lows, right? We made the lows down here at 35K. If you bought at 35, 3,200, you're fine, right? Now we start grinding higher here, and this is also combined with a risk off period. Remember, 2018 to after 2020 was all risk off, and pretty much 2019 to the end of 2020 on our system matrix was all risk off. So Bitcoin didn't do much. I mean, besides that pump, which we had this whole coincidence with high yield running throughout 20, which is very weird to have high yield running through a deflationary period, but this is what you saw all throughout 2019, which is why the SPY weirdly moved up. But I mean, bonds did phenomenal throughout that time period. So if you were in bonds, it's not like you missed it. You were in the right place. You had the opportunity to make money. And obviously this whole Bitcoin's a lot of noise here going on from 18K down to 3K to 12K, back down to 6K. And this is what happens here. Now we have high yield breaking down again here in 2020. Again, we get this Bitcoin sell off, and Bitcoin bottoms when high yield bottoms.
Hmm.
Okay. Now we have this move up, and this is where the fun starts. So we're on a risk on regime now, right? We take out, we flip risk on roughly in August. Okay. And we break all time highs here in November of 2020 of on high yield.
And
Shortly
that's
after,
right when Bitcoin goes parabolic.
Bitcoin goes parabolic. Now, Bitcoin continues to go parabolic until what? Bitcoin's Bitcoin hasn't made an all-time high since November.
Which
HYG,
coincides with
yeah,
HYG's
H,
all-time high.
HYG's all-time high I think is actually a month later in December, but regardless, remember the saying, if HYG is not making all-time highs, no love for Bitcoin.
Yeah.
You can't you can't go into Bitcoin unless HYG is making a new or grinding higher, making new all-time highs. Now, granted, if we have a huge sell-off in HYG, this is just a hypothetical scenario. If HYG gets completely destroyed, will it take HYG going to an all-time high for Bitcoin to recover? I want to say yes, but I don't. But I we don't really know because that hasn't happened besides COVID. And literally, just remember that Bitcoin didn't take out its prior highs, which I think what happened here, like I said earlier, is the bond market was getting faked out by a fake risk on regime, which our system matrix was picking it up as risk off, and bonds did phenomenal throughout this time period. I know I said that already, but Bitcoin did nothing and actually grinded down. And I think that there wasn't the hype behind Bitcoin that it needed in the right regime. So there was not the demand that required it to really pump. And sure enough, right when you got the risk on pump here in August, September, August, boom, Bitcoin to the moon. Now you could have bought it here at 32K, or here actually right here. It went to HYG broke out November 5th, 2020. Bitcoin was at 13,000. It had yet to breach its all-time high. But we have HYG and a risk on regime making all-time highs. Bitcoin's in there, you
Wow.
know?
That's wild.
So
It's
boom.
wild how well it works.
I know. And now we have an all-time high in December on HYG, but ever since we've gotten completely destroyed. So I can't see Bitcoin going up to making a new all-time high unless HYG is at its all-time highs.
Yeah. And it's nice because it's not just some arbitrary technical analysis garbage.
Right.
It makes sense, like
Right.
when when there's an environment for risk taking, risky assets like Bitcoin will go up. So
Right.
it just
So
makes sense. So like the HYG ETF is essentially showing you, are we in an environment to take on risk? Are people
right.
taking on risk?
Right. And the big problem here with Bitcoin that the maxis don't want to tell you is Bitcoin's at 39K. What happens if it goes to 20,000? Right?
Yeah, which is very possible.
Very possible because of its underlying volatility. Bitcoin can go, just remember Bitcoin was at 64,000 or 6 well, I mean, I think it was some meme number, right? It peaked at like 60. I think we got to go to the I don't have it on here. I think it's like between 60. I think it's 69K. Don't quote me on that, but regardless, if Bitcoin were to get cut in half, right? So we take 69 divided by 2, what's that? 30 38 and a half, right? 34 and a half, sorry. So 34 and a half. 34 and a half. Where are we at right now? We haven't even gotten under 35. We're not even under a 50% drawdown from its recent all-time high.
Yeah, which is easy for Bitcoin to do. It's
Easy
done
for
it
Bitcoin.
multiple times.
Bitcoin has gone from Bitcoin has been down over 70%. So let's just take 65% off of this. That's 24,000.
Yeah,
Do you know how many
we're
people that
already
would
pretty much
crush?
there. Yeah, especially with
No,
all
no,
the leverage that's involved with
yeah,
cryptos.
yeah. I said 24,000, not 34,000. Sorry. I don't know if you.
Yeah,
Oh,
yeah.
you heard that.
Well, we're
Okay. Yeah,
pretty
yeah.
much almost at 20,000 at that point. Then,
Oh, at 20,000. I thought you said we're at it right now. Yeah, no, yeah, dude. Listen, at 24,000, 20K is possible. I mean, we're right
yeah,
there.
easily. And
Yeah.
so the amount of leverage that people are
Hmm.
using in crypto, that just adds to the volatility because people
Yeah.
get margin called. People.
Unfortunately, you're right there. I mean, if you go on Binance, I know that it's not, buy these products really aren't available in America. I'm sure there's some platforms that have them though, these, offshore platforms. But on Binance, you can go up to like, I think it's like 1,000 to 1 or some stupid number leverage.
That is
1,000 to 1 leverage on
so
Bitcoin trades.
dangerous.
So dangerous.
That's wild.
I know. But long story short, we are not crypto bulls. We do not see a reason to own Bitcoin at the moment. We do like crypto though. We will long it if it's the right time, the right place. Because
There will be a
honestly,
time.
yeah, honestly, I don't care what anyone says. These gains are, you literally cannot, like, these types of returns are absolutely insane. Like,
Yeah.
just remember in 2020, the COVID bottom was like roughly 5,000 or 4,700.
Yeah,
We
like
went up to
where else
69K.
can you get that 5,000 to 69K? Where else
Yeah.
can you get that?
I mean, we're talking about almost a 14 times return.
That's insane.
A 14 times return.
That's
In
like a lotto options play,
Yeah,
except
that's like a lot.
you
Yeah,
got
but you
zero
have
time decay or
yeah,
anything.
you got super high confidence too because you understand the environment. So it's like, I'm gonna put money in this, and like, I'm not. You're right. I'm not gonna get time decayed, or I'm gonna. I'm not gonna get. I'm not gonna get like delta squeeze where like you're going. Or I should say delta squeeze, but like, the increase of delta is gonna, as the option goes further in the money, decreases your payout because the deltas are much
Yeah.
higher,
Yeah,
and
you got
or
none
I
of
should,
that. You're just
yeah, it's realistically gamma. Gamma's basically getting obliterated as you go deeper in the money. So the rate of change of the option is much lower. So you're not going to make as much. But we don't have to go into that whole spiel right now. Realistically, what's happening here is we're not buying Bitcoin. Simply put, right?
yeah.
Let's save that. Let's save the
And
banter.
also like this HYG idea. It's also just another tool in the tool belt. You don't
Mhm.
base an entire trade theory off of just one thing like this. It's got to coincide with what regime we're in. It's got to coincide with other asset performances and everything. Like there's a lot of factors that come into play. You don't want to have just that one thing that you rely on because that never works. The market is so dynamic. One tool that you have is never going to be the answer in all cases. So this is just another
Right.
tool in the tool belt to look at,
Right. Right. And here's a good example. 2018. This was all stagflation, deflation area. So obviously the highs are not going to match well with a risk on asset, right? Or I should say a risk asset. This is Ethereum. So this is
Hmm.
the same thing as Bitcoin, right? Ethereum, remember from here, from 2018 to end of 2018, early 2019 to the mid 2020 was all risk off. And once HYG took out its all-time high, Ethereum at that point was $479.
Wow. This actually looks even more
Yeah.
correlated with it.
Yeah, I mean,
But
we'd have to go back and look, but the problem with crypto is the decrease of liquidity or as you go back further in history, and it's hasn't been around as long as, I could go back on a bond index on Bloomberg. I can go all the way back to like the 90s. I can't do that with Bitcoin, so it's very hard to really take a longer term view on it. But yeah, you're right. I mean, even here, we this last rally here, we are stuck in, like, this is almost looking like it is a lower high now that it's been put in. The question is, HYG breaks lower, will Ethereum take out 2400 and lower? And
yeah.
if you have a real bad credit event in a deflationary period, which is usually where these come, could Ethereum go back to $1,500? And the problem, or I should say, the answer to that is it's possible if HYG gets destroyed. This is what we look at because we know HYG is going lower regardless of risk on. I mean, we know that the odds of HYG going lower are very high in the given regime because it's a risk off regime, and that's when HYG tends to do horribly. So in that case, we understand that crypto is not going to be a good investment either, which is why we aren't touting or the horn of any crypto positions. We're not in any crypto positions for that reason,
Yeah. And I
right?
I guess that's a good place to end it off. I think that that wraps things up.
I think that's a good place to end it
Yeah.
too.
So hope you guys learned something new with this HYG tool. It definitely works, and it makes sense. There's a reason why it works. So yeah, keep an eye out on it. Thanks for listening, and have a great Easter.